Hello everyone, welcome back. We are solving 2025 May-June paper 12. This is our third part of the video, so we will be solving from question number 21 to 30 today. Question number 21. A company had falling balances at 31st December. Inventory, then trade receivables, allowance for irrecoverable debts, bank overdraft, and cash in hand. So current ratio is 2.5:1. What was the value of trade payable at 31st December? So how do we calculate the current ratio? Formula is current assets divided by current liability. And on 31st December, these are the list of current assets and liabilities we have. But in this list, trade payable is missing. So if we find out that missing figure, that is our trade payable amount. Now let's start with that. So my current assets divided by current liability will give you equals to 2.5:1 or divided by 1. So let's look at what are the current assets we have. We have inventory. So inventory out here. Okay. Let's just directly write down the value. 31,000 inventory plus trade receivable 88,000. But there is an allowance for irrecoverable debt. Now, when we write trade receivable balance in a statement of financial position, we write trade receivable minus allowance for irrecoverable debt. So on 31st December, our balance will be 86,000. Okay, trade receivable 88,000 minus 2,000. And then bank overdraft is a liability, and cash in hand, which is also our asset, plus 5,000. Okay. Let's divide this with the liabilities, which the bank overdraft 9,000 and trade payable, which is the missing figure. So let's write down trade payable for now. And this is equals to 2.5:1. Okay, let's add all of this. So all of this is 122,000 and this is 9,000 plus trade payable. And then this is equals to 2.5 divided by 1. Now I want you to do the cross multiplication out here. And if I do cross multiplication, our answer would be like this. 122,000 into 1, which is 1 taken on this side, equals to 2.5 into 9,000 plus trade payable. 9,000 plus trade payable. Okay, this is into. Now if I further elaborate this, 122,000 equals so 2.5 into 9, so 2.5 into 9,000, that is 22,000, and then plus we'll have 2.5 into trade payable. Okay, this is not taking equals to. Let me just write down trade payable. Okay. And now let's take this on the other side. So 122,000 minus 22,500 equals 2.5 into TP, trade payable. Okay, I can do one more step out here. So I subtract this one first. 122,000 minus 22,500, which will give you, wait, I have it here. So 99,500 equals to 2.5 into trade payable. So what I can do is I can take this 2.5 also on the other side. So this is a multiplication. When I take it on the other side, it becomes division. So 2.5 divided by 2.5 equals to trade payable. So 99,500 divided by 2.5 is 39,800, and that is the amount of trade payable. Okay, so the correct answer for 21 is 39,800B. 22. The table shows year-end information for a company, statement of profit or loss, and statement of financial position. Profit for the year 55,200, then finance cost 12,000, total assets 350,000, and total current liability is 70,000. What is the return on capital employed? So we need to calculate that. In order to calculate return on capital employed, the formula is profit from operation, or we can also say profit before tax and interest, divided by capital employed into 100. And it will give you a percentage. So profit from operation is profit before interest and tax, and capital employed is equity plus non-current liability. So we calculate that amount, both of this here. Okay, if you prepare a statement of profit and loss account, then you have profit for the year here, okay, which amount is 55,200. Okay, and then we have profit from operation somewhere here. And profit from operation for now we don't know, but from this amount we subtracted interest and tax. So tax information is not given in the question, but the finance cost is given. So we subtracted less finance cost, which is basically interest. Okay, and the finance cost is 12,000. So minus 12,000. So from this amount we subtracted 12,000 and we got 55,200. So question is, what is this amount? So simply add them together. Okay, so 55,200 plus 12,000. So 67,200 should be our profit from operation, and in that, when we subtract 12,000 as finance cost, we have a profit for the year 55,200. So the first part of the question is there. So this amount is 67,200. Okay, profit from operation. Now we need to calculate capital employed. So let's do it here only. I'll just make it somewhere here. Okay, I don't need this one else. If we are making a statement of financial position, where is that? If we are making a statement of financial position, under our assets, we have non-current assets, then we have current assets, and then we have total. Okay, and here it says that current assets minus non-current asset total is 350,000. Then we have equity and liability. Equity we don't know for now. Okay, and under liability we have non-current liability, that also we don't know. And then we have current liability, and that current liability amount is 70,000. Okay, and when I add all of this, the total should be same. Okay, total should be 350,000. Okay, so that means equity and non-current liability is when I subtract 70,000 from this 350,000 is the amount, total amount. Okay, equity and liability total, this amount is 350,000 minus 70,000. Okay, that is 280,000. And I told you that capital employed is equity plus non-current liability. That means this 280,000 is my capital employed. Okay, so divided by 280,000. And this amount should be multiplied by 100. Let's calculate that. 67,200 divided by 280,000 into 100. And this will give you 24%. So return on capital employed is 24%. So question number 22 is D. 23. A restaurant owner paid the following: cost of food ingredients, maintenance of cooking appliances, wages to the chef, and wages to the restaurant manager. Which costs are indirect cost? So indirect costs are those costs which are indirectly helping us in production process. Okay. So number one, food ingredients. These are the direct cost. Without buying ingredients, I cannot make food. So this is my direct cost. But the maintenance of cooking appliances is indirect cost. They are not directly helping in production, but indirectly helping. And then the wages for the chef is also direct cost. Without paying wages to the chef, I cannot make food. So these are direct cost. And the fourth one, wages to the restaurant manager, is an indirect cost because manager does not help in making food. Okay, he is indirectly assisting it. So these are indirect cost. So right answer for 23 is 2, maintenance of cooking appliances, and 4, wages to the restaurant manager. So correct option for 23 is 2 and 4, C. Question 24. The total cost for each of 2 months had been recorded. Variable cost per unit remained constant. The total cost increased by 1,000 in July. Okay, variable cost of 1 unit is same, but the total fixed cost is increasing. And here they mention that in June we are making 8,000 unit, in July 10,000 unit. Total cost, which is including fixed cost and variable cost, is paid 76,000 in June and 86,000 in July. So what is the total of the fixed cost in July? Okay, we need to know how much is my total fixed cost in July. And this question is easy to solve if we know the process. So if you look at here, output, I will not do this. Unit that we produce is 8,000, and in July we produced 10,000. Now the difference out here is 2,000 extra I produce, which is this minus this. Okay, so this is your difference. And similarly, cost, which is the total cost, I paid is 76,000. Okay, and then this is 86,000. Okay, the difference that I paid out here is 86,000 minus 76,000, which is 10,000. So to produce 2,000 extra unit, I paid 10,000 extra. Okay, but one condition that they have mentioned is the fixed cost is increasing in July. So this extra cost that I'm paying also includes this 1,000 of fixed cost, which is increasing compared to last month. Okay, so if I remove this 1,000, then the remaining amount is 9,000. Correct? So to produce 2,000 units, I paid 9,000 variable cost. I can say that. Okay, because extra unit produce will increase only variable cost and not fixed cost. And fixed cost amount was already given, so I removed that. Okay, the reason that I'm doing this is to find out what is the variable cost of one unit, because it says variable cost does not change whether I produce 8,000 unit or 10,000 unit. So right now to produce 2,000 unit, variable cost we are paying is 9,000. So to produce one unit, the variable cost that I am paying is 9,000 divided by 2,000. That is 4.5 per unit, and this is your variable cost. Okay, if this equation is true and variable cost does not change, so in the month of July we are making 10,000 units. So to make 10,000 units, variable cost we paid is 4.5. So the total amount that we paid is, okay, it's not showing me, so let me just do it here. And 45,000, this is your total variable cost. Okay, but altogether amount I paid is 86,000, and my total cost out here is 86,000. That means the remaining amount is my fixed cost. Okay, so total cost minus variable cost from there, which is 41,000. And your correct answer out here is C, 41,000. 25. P Limited uses an overhead absorption rate of $15 per machine hour based on the budgeted machine hour of 8,000 per month. Okay. In July, production required 8,500 machine hours. The under absorption of overhead amounted to 16,500. What was the actual overhead in month of July? So under absorption is basically when we compare the actual overhead with our budgeted overhead, and if our budgeted overhead is less than the actual overhead, we call it under absorption. Example, if our actual overhead is 100,000 and my budgeted overhead is 80,000, then this is under absorbed by 20,000. Okay, hope you understood that. Now let's calculate. So budgeted overhead, they said that for 1 hour, per hour we will pay $15 per machine hour. Okay, so for 8,500 machine hours, when we actually produce product in July, we required 8,500 hours. So for 8,500 hours, how much is my cost? Okay, how much? We can calculate this easily, which is 8,500 into 15, and that is 227,000. And this is your budgeted overhead. Okay, and then we compare this with the actual, and this information we don't know. But when I compare this one, there is under absorption. And I told you that under absorption is my budget is less than the actual. Okay, so that means this actual amount most probably be more than my budget expense. And how much more? They said it is exceeding by 16,500. Okay, that means in order to calculate the actual, if I simply add this two, I can find out my actual expense, the actual budget. What I'm saying, actual overhead plus this. So if the actual overhead is 44,000 and the budgeted overhead as 127,500, then in that case under absorption incurs by 16,500. So your correct answer for question number 25 is D, 144,000. 26. Which statement describes the purpose of overhead allocation? If you remember this whole chapter, the first thing that we did was divide the overhead using the basis of apportionment. And we apportion the cost in both production department as well as in service departments. Okay, but later we also do reapportionment of service department cost to the production department. Okay, so the reason why we are doing is so that we can pass on this cost overheads to the product. Okay, and product will be made only in production department. So the main reason why we are allocating the overhead is assignment of specific cost to production department. Okay, so that this cost can be transferred to the product. 27. A manufacturing business provides the following budgeted annual information. Direct wages $12 per hour, 600,000. Fixed overhead 160,000. Fixed overhead are observed on the basis of direct labor hour. Okay. A job required a direct material costing 480 and needs 30 labor hours. The business wishes to make a profit margin of 25% for this job. What is the price to be quoted for this job? So, in this question, they have given us how much I'm charging for the labor. Okay, so labor per hour, direct labor, we are charging per hour 12. Okay, so total direct labor is 600,000. One more zero. Okay, question is how many labor hours are there? Okay, if we are paying $12 for 1 hour and total amount we paid is 600,000, that means total labor hour is 600,000 divided by 12, and we have 50,000 labor hour. Okay. Now total overhead we paid is 160,000, and I'm doing this because the next part of the information says fixed overhead are observed on the basis of direct labor hour. So overhead absorption rate of this overhead is based on the direct labor hour. So that's why I'm calculating direct labor hour so that we can calculate OARs. Okay, so OAR is fixed overhead, which is 160,000 divided by the total labor hour, which is 50,000 here, and overhead absorption rate is 3.2 per labor hour. Okay, now this would be helpful when I calculate the cost out here. So let's calculate the cost. We have direct material cost given in the question, $480. Then we need direct labor, and direct labor, they said they require 30 direct labor out here, and then each hour of labor requires $12. Okay, direct wages, so $12. So 30 into 12, 360,000. Now we need to calculate overhead. Overhead is, we require 30 labor hours, so overhead is also charged for those 30 hours. Okay, 30 hours, and the overhead per hour we are paying is $3.2. So 30 into 3.2, which is 96. Now this will give you total cost. $963 is your cost. But they are not asking you about the cost. They are asking you what is the price to be quoted. So in this, if we add profit, which is 25% margin, then we can calculate my quotation price. Okay, but the problem is margin cannot be utilized to calculate profit amount in the cost, so we need to convert margin into markup. Okay, so if this is margin, a normal calculation is, in this case, 25%, so 25 divided by 100. Now if I convert this margin into markup, then this is 25, which is margin, divided by 100 minus 25. If I write this in formula, I'll just write it for the conversion. Margin divided by 100 minus margin. Okay. Now this is the profit percentage that I can use to calculate profit included out here. Okay, so let's do that. 936 is the cost into profit percentage is 25 divided by 100 minus 25 is 75. So 75. And profit here is 312. Let's add profit and cost. This plus this, and this is our price to be quoted. Okay, 1248. Your correct answer for 27 is B. (28) Which factor would cause the variable cost line in break-even chart not to be a straight line? Okay. Number 1, a bulk buying discount from supplier. B, employing an extra factory supervisor. C, plant and machinery depreciation. And D, renting additional warehouse space. Okay, let's look at A, bulk buying discount from supplier. What does it mean is a variable cost is a straight line. A variable cost line looks something like this, a straight line like that. Okay, and this is the because it is increasing proportionately. Okay, for example, if the variable cost of 1 unit is $20, then the variable cost for 2 unit would be $40, and variable cost for 3 unit and $60, and so on. Okay, so it will increase in a proportional manner. So as the number of unit increases, cost also increases in a proportional line. So that's why this is a straight line. Okay. But what is question options 1A is saying bulk buying discount from supplier. So if I buy in bulk, then this curve or this line sequence will break. Okay, for example, if we buy 100 unit, so 20 per unit, so for 100 unit I should be paying so $2,000. Okay, but if we get a discount from our supplier and the supplier says that for 100 unit you don't have to pay me 2,000 but only pay 1,900. Okay, now in this case if I look at the average cost would, or the variable cost per unit would decrease. So which is 19 divided by 100, so $19. So what we said was our rule was we are paying 20 per unit, but when we buy in bulk for 100, then we have to pay only 19. To explain this, I'll take you to different sheet. If you look at here, let's say before the discount, this is what we are receiving, okay, at a very proportional manner. So this is a 20. So if you make 1 unit, you pay 20. If you make 2 units, you pay another 20, and then 20 and 20 and 20 and so on. Okay. Now because this gap represents 20 difference, so that's why this is in a straight line. Okay. So as soon as we get discount, this difference of 20 would shrink. So let me shrink it little more for us to look at the difference out here. Now if I join from point to point, then here the curve would looks like this, right? Another one curve would look like this, and let me make one more. It would look like this. So did you see that? When there is a discount, the average cost decreases, so cost per unit decreases. So my cost curve would also slant or curve a little instead of being a straight line. So we can say that for 28, the correct answer is bulk buying discount from supplier, because this would decrease the average cost or variable cost per unit when we receive discount. So the line is not straight. $29. The following information is available for a business. Budgeted fixed cost per month 2,000, target profit per month, then budgeted variable cost per unit and selling price per unit. Fixed costs are expected to increase by 500 per month and variable costs are expected to increase by $5 per unit. Which value of revenue will require to achieve the target profit? So target profit formula is very simple. It is exactly like break-even point formula, where is break-even point formula is fixed cost divided by contribution per unit. But here, along with the fixed cost, we will also include target profit. Okay, we also know consider as desired profit, but I'll just write down here target profit. Okay, and this will be divided by contribution per unit. Now, this will not give you the revenue, but it will give you how many units we should sell in order to reach this much of profit. And if you simply divide that output or the sales unit with the selling price, we'll get our targeted revenue here. Okay. Now, in this question, fixed cost is given 20, but sorry, 2000. In this question, fixed cost per unit is 2000, but it's expected to increase by 500. So let's look at the new figure of fixed cost, which is 2500 is my fixed cost, plus target profit is 3000, so 3000, and let's divide that with the contribution per unit. Contribution per unit is selling price minus variable cost. Selling price in this question is 40 and the variable cost per unit is 15, but it says that the variable costs are expected to increase by $5 per unit. So now the new variable cost would be 20 per unit. Okay, this is your fixed cost plus profit or target profit, and this is your selling price minus variable cost to find out the contribution. So let's do that. 5500 is the total up there, and then selling price minus variable cost is 20. Now this will give you number of unit to be sold to reach profit of 3000. So 5500 divided by 20, and this is 247 units needs to be produced and sold to achieve a target profit of 3000. But we need to calculate this in terms of revenue, and each unit is sold for 40, so we'll multiply this with 40. Okay, so output into revenue, and that is 11,000. So your correct answer for 29 is D, 11,000. 30. What are the assumptions of cost volume profit analysis? Number 1, fixed cost per unit is constant. Number 2, selling price per unit is constant. Number 3, sales volume is constant. And number 4, variable cost per unit is constant. Cost volume profit analysis examines how changes in the sales volume or cost affects the profit of the business. Okay, so here when you change the volume, then the cost or fixed cost per unit will change. Okay, for example, if we are selling 100 units and the fixed cost that we are paying is, let's say, 5000, then the fixed cost per unit is fixed cost divided by output, which is 50. But if we sell, let's say, 200 units, and fixed cost will remain same because total fixed cost does not change, but fixed cost per unit will change out here, which is 5000 divided by 2000. So this is not the assumption that we are making. Okay, so fixed cost per unit should also change out here, but the selling price per unit should remain constant. Sales volume can change, so I was selling 100 unit, now I am selling 200 unit, but selling price per unit should remain same. That is the assumption that we are making. Sometimes what happens is, in real life situation, when we sell more units, then we need to decrease the selling price. Okay, but here the assumption is that selling price remains same, either I sell 100, 200, 500, 1000 units. Okay, so that is the first assumption that we are making. Second one, sales volume is constant. Again, I just did the analysis out here where we are changing the number of unit that we are selling from 100 to 200 and sometimes 200 to 500, 500 to 1000, and we are looking at what effect does it have on the profit. Okay, so sales volume would keep on changing and it is not constant, so this is not the right option. And last one, number 4, variable cost per unit remain constant. And we assume that cost of making product, fixed cost remains same and variable cost per unit remains same. Okay, so there is a difference between total variable cost and variable cost per unit. So if you make 100 units and if you pay, let's say, $10 for one product, then my total variable cost is 100 into 10, which is 1000. Okay, and we are talking about this variable cost per unit and not this total. So if you make 200 units, we are still paying $10 per unit, but total variable cost will change from 1000 to 2000. Okay, so here variable cost per unit is constant, so we are saying that variable cost should remain same, and that is the assumption that we are making, that even if we produce more, variable cost per unit will remain same. So correct option for question number 30 is 2, selling price per unit is constant, and 4, variable cost per unit is constant. So D. So with this, we come to the end of this particular paper. We'll solve more past papers, and if you have any questions or concerns, please write in the comment so that I can get back to you. Till then, happy learning and have a nice day. Bye.